with Top Shelf Traders. Thank you for joining us. Good morning, good afternoon, good evening, wherever you are in the world. It's great to have you here with us. This is our Saturday morning free education event, and we have folks coming into the room here with us. So as folks come in, we'll just do a quick sound and visual check. If you can let me know that you can hear me okay and that you can see the screen okay, that would be great. It should say the Oil Trading Group solving the trading puzzle there in front of you. We've got the questions box open. Just go ahead and put a quick yes in there. We'll keep an eye on that. Perfect. All right. Good morning. Right on. We've got a really good sized group here today, and we've got a number of folks that are continuing to join us. It's our pleasure to have Jason Love here with us with the Oil Trading Group. And the title of his presentation is the Holy Grail, the day trading Holy Grail. It really does exist. Now, we know from a recent survey that we conducted at Top Shelf that day trading and risk management and consistency of performance are huge themes that our universe and our audience is really interested in. So when we had the opportunity to have Jason join us, we jumped at it. A little bit about Jason. He's the founder of the Oil Trading Group, and one of the things that motivated him to get into the business was a glaring need for quality day trading education, and we really relate to that. We think there's a void right now in the marketplace for quality content and quality education. Prior to becoming a day trader, Jason ran a 300-seat call center, the VP of operations, so he comes from the corporate world, and he's also a United States Navy veteran. So we all know that discipline is important when it comes to trading, and we're going to be talking to a guy and hearing from a guy that understands the value that structure and discipline can have in day trading, especially with volatile financial markets. When Jason's not trading, he's coaching his son's youth baseball team. And Jason, hopefully you don't mind me saying this, but he's a Texan. So prepare yourself for the accent. We've really enjoyed having Jason with us. We're going to be publishing one of his ebooks, and he's a frequent contributor on Top Shelf Trading. So this is an interactive session, as always. Please, if you have questions, throw them in the questions box. I'll keep an eye on the questions box, Jason, for you. And then this was asked once at the outset. Of course, this is being recorded. This will be posted. So if you have to leave, duck out early, whatever you need to do, or if for whatever reason you may have missed this event, we'll go ahead and post it on the YouTube channel. So I won't hold you up any further, Jason. It's great to have you. Thank you for joining, and I'll go ahead and turn it over to you.
Excellent. Well, thank you for the introduction, and thank you for allowing me to talk to your world here today. It's certainly appreciated.
Of course.
Yeah, no. So a couple things here, just a couple housekeeping notes, if you will. I'll try to keep the Texas accent under control as much as possible. And then I'm working out of the home office today. So having said that, I will try to keep the background noises to a minimum, but you never know, right? Unexpected things. So my apologies in advance if there's something that disrupts us here. It won't disrupt us for long, but just I am working out of the house today, so just note that. So again, if I haven't turned all of you off by telling you that there is a day trading Holy Grail, hopefully you'll stick around with me and look and see, right? We're all told that there is no such thing as a Holy Grail in trading, and while that is mostly true, what I want to show you today, I believe, will maybe change your mind somewhat about that. I see a couple of people in here that are regular members of our group. Wahid, it's good to see you in here today, specifically, and I've seen a few other guys that have been with us in the past. So let's get started here if we can. Hopefully you can see the screen okay. First of all, again, I want to say thank you to all of you for attending today. I want to thank Jason and his team over at Top Shelf Trader for the time that they've allowed me to come speak to you today on a Saturday morning. I know all of our time is important, and it is good to have all of you here with us today. All right, so today's agenda is going to go like this. Who is the Oil Trading Group and why is this guy talking to us? We're going to talk about the trading philosophy and what I would consider to be the holy grail of trading. We're going to talk about our trading approach and tactics. We're going to do a quick chart review. We're going to go through what we call the OTG risk analyzer, also affectionately known as the desktop psychologist, and we'll talk about why that is. And then there will be questions, I'm sure, as we go through this, but I'm going to try to hold these questions till the end of the presentation, and we'll come back with the Q&A session quickly. Now, we promised you that we'll try to keep this to within 60 minutes, and that's what my objective is. I ran through this one time this morning. 50 to 55 minutes was about how long it took me. It may go through a little bit more quickly because unlike most Texans, I can talk somewhat. I get a little bit quick sometimes when I talk. So let's move on here. Who is the Oil Trading Group? Again, my name is Jason Love, and I'm the founder and lead trader of the Oil Trading Group. And we just had our 7-year anniversary for opening the room. The reason for the room way back in the day that we opened is there was a glaring need, in my estimation, for professional educators, right? Jason gave you a little bit of background on my history, not to get all Shirley MacLaine on you, but in a previous life, I was the vice president of a 300-seat call center. And so there was definitely, I understood the need for professionalism when you're doing things like this. And I'm going to tell you a quick story. So when I first started trading back in, 02, 03, I was in the looking at the currency markets, and for a number of reasons, up to and including just the amount of time that you had to be available to catch the moves, and my personality type, it just became a little much for me in terms of the number of hours to trade in the currency market. So I switched over to the commodities, and I got really fascinated with oil, and I found a trading room, much unlike some of you have done. I found a trading room and began to study and look for techniques that would help me trade. Well, I got into this room, and just as a way of note, as Jason mentioned, I was in the Navy once upon a time, and I never really got into coffee, right? All of my shipmates would drink coffee early in the morning or late at night on shifts. My caffeine of choice was through a carbonated beverage like a Diet Dr. Pepper or something like that. So as I attended this trading room for the first time, I would hear that familiar sound of that pop, right, that you get from a carbonated beverage, and I would hear this thing go off 4 times an hour, right? And so we would trade 3 or 4 hours a day. I'm like, man, this guy must be wired for sound. 12 to 16 of these a day is a ton, right? And so after a couple days, I finally said, hey, man, I'm a Diet Dr. Pepper guy. What are you? And he kind of laughed at me, and he said, ha, that's not Diet Dr. Pepper, Jason. That's Coors Light. Holy crap, I said to myself. So he is popping 12 to 16 of these Coors Lights every single day, and no wonder I couldn't reach him for questions when the trading session was over. So I quickly moved on to the next trading idea, and I got into a room where the guy seemed pretty good. He was a little quirky. He was a singing clown by trade, and he would day trade in the mornings, and so he would serenade us with clown songs and stuff like that as the days would go on, and his trading, meh. But what he would do is he would send out these screenshots and these ideas of trading that didn't happen while we were in the trade room together, and in some cases didn't happen at all. And so what I quickly found is the thing that you guys have found as you've gone through the process of trading and looking for educators, etc., is that there's a lot of guys out there that ain't so good at this, right? And so we said that there was a need for professional educators, and we started the Oil Trading Group back in October of 2010. We have an online presence at www.oiltradinggroup.com, and you can also visit us on Twitter, Facebook, YouTube, and Vimeo. So that's a bit about us and the Oil Trading Group and why I started the group that we had here today, and started the trading group, and why I am here with you today. All right, so let's get into this Holy Grail discussion. What is this thing that he is talking about? All right, so I'm going to give you a quick trading test. Can you tell me the difference? On the left side of the screen, there is a potential loser, and on the right side of the screen, there is a potential winner. What is the difference, and how do you know the difference between this potential losing trade on the left and this potential winning trade on the right? All right, I've got a few answers coming in. There doesn't look like there's a difference, some of you are saying, and that's exactly right. There really is no difference at all. And that is the dilemma that as day traders we are faced with. As day traders, we don't know the difference between a winning trade and a losing trade before one of two things happen. Price either hits our target or hits our stop loss, right? So they all look the same when you get into the trade. The red dot on the left is a potential loser, the red dot on the right is a potential winner, and they all look the same when you get into the trade. So, a couple of things to think about. What you cannot control is less important than what you can control. All right, so let's talk about what that means. On the left side of the screen, you can see the things that you cannot control when you're trading. You cannot control where the market is going to go. You can't control price movement, and you cannot control the ultimate outcome of a trade. But what you can control is when you trade, time of day, when not to trade, holidays, FOMC meeting minute days, or those may be the times you like to trade. Maybe it's in the summer where you take 2 or 3 months off, but you can control when it is that you do not trade. You can control the instruments you trade, you control when you exit a trade, you can manage the risk, you know, worst case scenarios. You get to choose your own tools. If your feelings towards the outcome of the trade you can control, and you can control how much or how fast you learn your particular system or what you learn about trading. So again, what you cannot control is less important than know all of those things that you can control on the right. All right, why do I bring that up? Because risk and understanding risk is important, because you can control the amount of risk that you have in a trade. I want to show you this quick chart here. So if you look here at the very bottom, it is the percent of risk that you have, and on the scale to the left, it is the number of losing trades or days that it takes to get you to a zero balance. So for example, if you are risking 1% of your account every trade or every day, then you can stand to lose 100 trades in a row or 100 days in a row, depending on your risk, whether you're risking 1% a day or 1% a trade. Conversely, if you're one of those traders that risk up to 15% of your account balance per trade, then you can only withstand it about 6.5 times, right? So you can see that if you are over leveraging yourself, you can go through a period where you lose 6 trades in a row and you're done, right? You've blown out your account, it's over, and off you go. So again, understanding the impact of risk per trade or risk per day is important, and you can control exactly how much of that risk that you handle, right? All right, so what is the importance of a good rate of return? So let's say, let's do this. Over on the left-hand side of this column, there is your winning percentage, okay? So 0% up to 70% on this graph, and on the bottom rather, down at the bottom, the scale is your risk-reward ratio. So if you are way at this side over here to the left, if you're risking $200 to make $100, then you're at a half risk-reward ratio. Way over to the right, if you're risking $100 to make $950, then that's a 9.5 times risk-reward ratio. So again, if you're way up here at 70% win rate, then you can have a very low risk-reward ratio and still be successful. So for example, if you're up there at 70% win rate, then your risk-reward can be half to 1, meaning that you're risking $200 to make $100, right? Down at the bottom here, the example that I've shown for you on your chart is with a risk reward of 2.5%, then the required win rate to break even is 28%. So let me ask you this question. Which one is an easier thing to do? Is it easier to win 70% of the time and know that you have the pressure of winning that rate all of the time in order to be successful? Or is it easier to say, gosh, I can be wrong 72% of the time and still be okay if I have the right reward parameters in place, right? So we all understand that the market's going to change on you. And I'm going to show you a couple slides here in just a minute of what it is that I'm referring to when I say the markets can change on you. But we all know that the market can change and go through processes, etc. But if you can say to yourself, look, I can be right only 28% of the time and still be okay in the long run, then you have an opportunity to be really successful in the long term. We'll talk more about that in just a minute. Okay, so there are really two paths to risk-reward success. Path number one, if you look at the top left-hand corner, there is the high win rate percentage, right? We just talked about that. And down at the bottom is a low risk-reward ratio. So if you're looking at this high risk-reward ratio, you can have a high win percentage and a low risk-reward ratio and still be profitable. So we just talked about that. If you're winning 70% of your trades, you can be less than 1-to-1 in order to be successful. But if it goes through a period where you have a high rate of return, a low win rate, so that drops from 70% to 50%, and your risk reward is low, then you're going to take a beating, right? You don't want to be in this quadrant down here. Conversely, if you have a low win percentage but a high risk reward, you can be profitable. And if you get to that point where you have a high win rate and a high rate of return, then as we talk about here, that's where the magic happens. So there's two paths. You can have a high win rate and a low risk reward threshold, but understand that a high win rate can be challenging, right? A high win rate can be challenging sometimes because the market does change and the conditions and environment in the market changes occasionally. And give me just 1 second here, guys. Give me just 1 second.
Hi there. Well, Jason's away. I saw a question or two come through here. Gopalan, I can see the screen just fine, so no problem on our end. But by all means, if you're experiencing an issue, let me know.
Okay, so my apologies for that. I told you I'm working out of the home office today. I've got the window open here in my office, and I saw a potential problem brewing, so my apologies for that. So picking up where we left off, and thanks for jumping in there, Jason.
All good.
Yeah, so you have two paths basically that you go to. Your profitable trading, you have a high win rate and a low risk reward threshold, but you understand that the market has a potential to change occasionally, right? And we all know that, and I'm going to show you what I'm talking about here in just another slide or two. And then on the other side, you can have a low win rate and a high threshold for your risk reward, and you're going to be successful. And then if you get it to where it's a high on both ends, then that is, again, where your magic will happen. All right, so let's understanding risk reward, and that is truly the holy grail of trading. So there are three components here to equity growth in your account. There is win rate, that is the distribution between wins and losses. There is your rate of return, how your winners offset your losses. And then there is the size of your losses versus the size of your winners. And so, or in other words, position size, right? So really there is one holy grail of trading. There are 100 people in here today, and there are as many different ways to enter into the market as there are people to enter the market. So for example, there are 100 of you that will have 100 different ways of looking at the markets. It may overlap, it may be similar in some ways, but you will all have some different way to do it. Sometimes half the group will win, the other time the other half will win. But when you're losing, you throw it back, right? You get out of it quickly. You do not hold on to it. One of the things that we talk about in the trade room quite a bit, and in this cut your losers short, let your winners run idea, is that if you're that type of trader, and invariably, let me say it this way, invariably I talk to new traders all of the time, or traders almost every single day, and one of the questions that I ask when talking to people to kind of understand who they are and what they're all about is I ask them this question: when your trade is winning, do you take one off and let the other one run? And invariably the answer is yes. Okay, so I will take one off when it's winning, but I am going to and then I'll let the other one run. So then I ask the flip side question. I say to them, okay, if you're doing that, are you cutting the loser short also? So if you have two lots on the CL and you have a 15 tick stop, are you taking one off at 8 ticks and the other one at 15? And invariably the answer is no. So there is a mind switch that's going on. So instead of cutting your losers short and letting your winners run, they are cutting the winner short, mitigating that winner and letting that loser run all the way to the full stop, right? So again, the reason that people are doing that is because they're not quite sure how to get it to that full target. We're going to talk some more about that in just a minute, but understanding how what you are doing, the key to equity growth, win rate, rate of return, and position size are going to help you get ultimately to where you want to get to. And that truly is the holy grail. Regardless of the market conditions, regardless of the setup that you're using, you are going to have the most success when you are considering your risk-reward ratio when you're trading. Okay, so how do I start doing this? Well, we have a couple of different ways that we look at it, but here is the basic framework from which we work. So if you take a look at that arrow down on the left, we have a top-down approach, strategy, if you will, or a top-down approach to doing this. If you take a look to the right, we talk about our tactics are aligned to our goal. Our goal, every one of our goals, is to be a consistently profitable trader, right? That's all of our goals. We all want to be consistently profitable. The strategy to get there is cut your losers short and let your winners run. And the tactics, which are aligned to your goal, are the steps, your setups, your technical analysis, your entries and exits. Those are your tactics to help to get you to the strategy, which ultimately gets you to your goal. We'll come back and talk some more about this. All right, simple enough, right? Cut the losers short and let their winners run. Got it. Well, not so fast, right? You don't need to be a theoretical scientist like my buddy here on the left, but in theory, this isn't hard, but in practice, it can be very hard, and a lot of traders never completely embrace this concept. And there's really only one simple answer for that, is they don't know how to do it. If they knew how to do it successfully, we would all do it, right? If we knew how to do it successfully, we would all do it. So going back to my days as the VP of the call center, there were 300 people that reported to me up through various levels, supervisors, managers, and a couple of directors that would report to me, and I would take the management team off-site every year, and we would have a goal planning process. And one of the discussions that we would have every year was we would talk about the policies and procedures that we would put into place to manage people. And so the way that you manage people is directly attributed to what you think about people. So if you feel like that everybody's there to take money from the company and not give their absolute 100% best, and they had their own selfish motivations in mind, and they were never there to really help the company, then everything that you did, set up for policies and procedures, would be geared around that type of approach. So you would have some really punitive, kind of hard measures. But if you said that people aren't doing what they're doing because they simply don't know how, they all want to try to do the right thing, they just don't know how to do it, then your programs, policies, and procedures would be aligned with that idea. So there would be more education and nurturing and fostering of ideas and those kinds of things. And it's the same thing here. If I told you, hey, cut your losers short, let your winners run, you would all say, yes, let's do it. But the reason that you don't do it is not because you don't want to, it's simply because you don't know how to do it, right? And so let's talk about that. Before I go through that, I've got to go through this disclaimer here for you. I'm going to show you a couple of screens with some results on it. So what you have to understand from this is that past performance does not guarantee future results. Unlike being performance records here, again, this may over or undercompensate for factors such as liquidity. The risk of loss in trading can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your specific financial condition. And the Oil Trading Group does not hold itself out as a commodity trading advisor. And given this representation, all information and material provided to you by us is for educational purposes only. Okay. let's talk about the next idea. Remember me telling you that if you had to be 70% positive in order to have an effective and not be break even, remember I said that the market can change sometimes, and it does, and I'm going to show you an example of that here, I think. It looks like give me just a second here. My PowerPoint is trying to freeze up. I'm going to come back here, one slide, maybe. All right, give me one more second, guys. Sorry about that. Come back here, and we'll see if we can get this to do the right thing. All right, so one more time. And zoom in here. There we go. All right, so we talked about the market can change, right? So if you look at the CL market in 2014, that's easy to trade, right? You can get 70% win rates when the market moves 5,600 ticks like it did in 2014, right? That's an easy market to trade. Go into 2015, market's a little bit more narrow, but there's 3,600, almost 3,700 ticks of range, right? And then you go to 2016, and there's still 2,800 ticks of range, but man, it sure is getting, man, I wish it was back like it was over here where there was 5,600 ticks of range. Now there's only 2,800. And now we're in 2017, and this was done, I did this slide into late September, early October, and the market's only had nearly 1,300 ticks of range. So when I tell you that conditions can change, right, it's easy to win 70% or greater right here, right? You just jump on board the short and off you go. It's a lot harder to get 75% right when it's up and down like it is in 2017. Now, I'm going to slide this chart over in front of you. This is a 4-hour chart for September of 2017, so just last month. And there were 20 trading days in the month of September, okay? There were 20 trading days. We had a holiday on the 4th, and there were 20 days that you could available to trade in September. 3 days, the range was 65 ticks. For 5 days, the range was 71 ticks. For 5 days, there was a 47 tick range. And for 2 days here, there was a 56 tick range. And then for 1 day here, there was a 17 tick range, right? So out of 16 days, there's 3, and 5 is 8, and 5 is 13, and these 2 days equal 3, right? It's 16 trading days where the range was less than 58 ticks on average. Why is that important? Well, in a 58 tick range, look at all of these wicks and all of these candles that are up, down, and up and down. This is where traders get chopped, right? If everybody talks about the trend is your friend, there is no trend here. So if you think, hey man, this thing's about to go up, it comes back down. This thing's about to go down, and it rallies. And all the while, you're being stopped out at these different places. But what if you could figure out how, when the market does break out back here and in between this period, what happens when the market does these types of things? Can you be there to take advantage of them because you have managed your risk properly, right? So we talk about the fact that the market changes, right? 2014, you just jump on board with your 70% win percentage, and it doesn't matter what your risk reward is because you're just winning every trade, you're killing it. But in 2017, when the market has come down dramatically, the range has narrowed dramatically, it's a lot harder to do, and it's why risk management is so important when you get into a month like September where the market, 16 out of 20 days, the market is in the most narrow of ranges over the 23-hour trading period. All right, so trading conditions change, and you need to be able to handle that. Systems can fail during changing conditions, but risk management will never fail you if you are properly aligned with it. All right, so cut the losers short, let the winners run. These are my trading statistics for that period that I just showed you from August to as of Friday of this week. All right, so I'm going to go through this really quickly with you. I'm always trading 2 lots. So everything you see on this screen is a 2-lot trade, right? Nothing, I'm never adding or subtracting. It's always 2 lots. My average winning trade is 2.3 times larger than the average losing trade here on these statistics. I'm going to go through, I'll expand this so you can see a little bit better here in just a second. The whole time on winning trades is 5 times larger than those losing trades. So average is 2.3 times greater. I'm letting the winners run. The whole time is greater, 5 times greater. I'm cutting the losing trade short. My largest winning trade on 2 lots, $1,700, was 5 times larger than the largest losing trade at $340. And despite losing or break even on 66% of my trades, I'm averaging a net positive gain of $230 per day on 2 lots of risk. Think about that for a second. I lost or broke even on 66% of my trades. Yet, this is the total gain and loss during that same time period on 2 lots. Why? Because my average winning trade is 2.3 times greater than my losing trade. So if you're a CL trader out there, you know CL can be crazy wild, right? So if I'm looking at trading 2 lots, that's $196 per losing trade. Divide that by 2, that's less than 10 ticks of risk on every single trade. Now, typically I'm averaging about an 11 to 12 tick stop, but that is right there. Your average losing trade is less than 10 ticks per trade. So, yes, I'm not going to win any trade room marketing awards here today by telling you that I'm winning 34% of the time, right? But that is the reality of trading. Isn't it cool that you can win only 34% of the time and still have the ability to be okay? So let's take a look at this a little bit deeper. I'm going to, here on the left, these are my winning days, and here on the right are my losing days. So despite the fact that I'm only winning 34% of my trades, I'm winning 62% of my days, right? So I've got a 62% daily win rate despite the fact that I'm only winning 34% of the time because I'm cutting the losers short and letting the winners run. The average daily gain is bigger than my average daily loss. So if you look here, average daily gain, 767, average daily loss, 647, right? So on the days that I'm winning about $120 more than I'm losing. So cut the losers short, let the winners run. And even on losing days, I'm still holding on to the winning trades 3 times longer than the losers. So for example, if you look over here on the right, the average hold time for a winning trade is 39 minutes. The average hold time on your losing trade is 13 minutes, right? So I'm still, even on the losing days, managing to hang on to the winners bigger than the losers. All right, so I want you to look at this here. I want you to look at this specific area right here. Here is the key to why, despite the fact that I'm only winning 34% of my trades, I'm doing okay. Average winning trade on winning days is $575. Okay, one step down, the average losing trade is $181. That is a risk reward of 3.2 times. So for every dollar that I'm risking on my winning days, I am returning $3.2. So $3.20 for every dollar of risk. On my losing days, I am losing 203 and winning 119. So 203 divided by, let's see, 119 divided by 203. I'm getting a 58% return on every dollar risked on my losing days. Okay, so if you'll notice that difference there, there's a big difference between what's happening on the winning days and how close that I'm keeping the winning ratio on my losing days, right? That is your key to long-term success. Cut the losers short and let the winners run. And me showing you that I'm only winning 34% of my trades, still winning 62% of my days, and up 1,100 ticks during that window is a key component to this, right? All right, so I'm going to put a bow on this really quickly. Your vision is why we are doing this, right? The why of what we are doing here is we want to all be consistently profitable. The what, your strategy, the what are you going to do to get there is I'm going to cut my losers short and let my winners run. And the how am I going to do this are your tactics. Determine market direction, identify decision points, and manage your risk. That's my tactics to doing this. You may have different tactics to do it, right? You may not be interested in market direction, but rather you're interested in, you know, some whatever, right? The way your tactics to get to the strategy, the what, and to get to your goal or vision, the why, couldn't be different than mine. I'm going to show you mine here today to give you an idea of the way that I see the world, but your tactics may vary. but your goal is the same as mine. You want to be consistently profitable all of the time, right? You want to come in and sit down and be consistently profitable. That's all of our goals. They all line up. The strategy, the what to do that, should be all of our goals as well. We all want to cut the losers short and let the winners run. We always want to make more than we're losing, right? We all want to do that. But how we get there can be different. The tactics can be different. All right. So step one for me is determine market direction. Is this a bullish or bearish market? Yep, I knew that was going to happen. All right, so let me restart this. Give me just a second here. It's not liking, for some reason, the presentation here today. We'll come back through this. I think it restarted here. And okay, so let's do this. All right, so we'll all agree. Well, just a second here. Let this slide pull in. I think we would all agree, okay, that 50.21 down to 48.70 on the CL, that this is a bearish move, right? Highs, a series of lower highs, and a series of lower lows. We would all look at that chart and we'd go, sure, that's bearish, no problem. That's easy to see, Jason. That's a bearish market. And so as we're determining market direction, we would look at that and say, clearly, this is a bearish market. But let's take a look at another chart. Now, that's the same leg, 50.21 to 48.70. But there's probably not one of you in here that would tell me this is a bearish market, right? This is a single leg in an otherwise bullish market. Low, higher low, higher low, higher low, right? And a bunch of higher highs. So the point of that is this. As we look through and try to determine market direction as one of our trading tactics, our first approach is to determine the direction of the market, and we do that on a higher time frame. That's the way that I approach it. I look at it on a higher time frame. This is a 60-minute chart on the right. It's a 1-minute chart on the left. And that is our way for step one of our trading tactics, is to determine market direction. Now, there are going to be guys that come into my trading room and they're going to say, gosh, you've been fading that high or that low all day long. And they're looking at this 1-minute chart and they're going, man, this guy's a joke. He's a counter trend trader. I can't deal with it. Right? He's not very good. He's taking losses in a clearly bearish market. Well, the underlying trend here is bullish, and there are going to be days where you are going to get pullbacks, and sometimes that happens. But step number one is to determine your direction in our trading tactics. That's step number one. Step number two for me is decision points. I'm a support resistance trader. And so for me, those decision points are places on the chart where the market is likely to react, either go long or go short. And while there are times when these types of levels are hit to the tick, these areas should be considered zones of influence more than they are surgical precision. Now, I was fortunate enough to have a friend, buddy, that traded for 30 years on the floor of the Chicago Mercantile Exchange in the S&P pits, and he used these levels that we now call market maker levels to trade in his own personal trading. They are dynamic support resistance levels, and they're based upon previous price action and time cycles. They provide the structure within the structure on an everyday basis in here. And so for those of you that have visited the room, or Wahid, who's a regular room member, can tell you that these levels are very accurate, right? They have a very good performance rate. Now, sometimes the market moves in a way that is different than what you would have hoped for. Right? It doesn't automatically do everything that you want it to do, but that's why you cut those losers short. And again, this system was originally designed by a 30-year veteran floor trader who gave me the information. We modified it to get into, to be able to trade electronically, and I trade these on the CL and ES. Now, while I don't personally trade the other markets, our students have successfully traded this system on the NQ, TF, Gold, and YM. So if you go back all the way back to what we talked about just a few minutes ago, that the reason people don't hold on for bigger targets is because they don't necessarily know how to calculate that bigger target or where the market is going to likely end up. All right, so let's go through this one more time here. We have 200 plus videos on our YouTube and website. So what I'm going to show you here in just a minute, I'm going to show you a couple of trades that were taken. They have been documented and placed on the website, right? So before we go too much further, I am not cherry picking charts and showing you stuff on charts that makes these levels look perfect or makes my idea of risk reward look perfect. I've actually taken these trades in the live day trading chat room. Okay, so they were actually taken and posted on the website in the day trading chat room. So if you take a look here, this is a screenshot from from my website. You'll notice that there are 21 pages worth of videos here. There are 10 videos to a page. I just couldn't fit the whole thing on in this picture. There are 21 pages worth of videos at 10 videos per page, right? Of me showing you, talking about the trade that we get into, and then actually showing you a live recording of that trade that we took in the room. Also, we have a YouTube channel where you can see the same thing, right? And you're going to get links to both of these things here in the follow-up email today to the YouTube channel and also to the website. But what I'm about to show you in terms of trades here, right, is going to be, you can back it up by watching the actual video itself of the trade as it happened in the live day trading chat room. So remember I told you the biggest win that I had this month or in this window of time was $1,700 on 2 lots. There's this trader view statistics from that particular day. It was one and done on this particular day. Not every day is like that. I may have a nice 100-tick trade that gets me out of the hole for the day, right? I may have been down 90 ticks going into it, 45 ticks a contract, and that's an exaggeration. Maybe I'm down 30 ticks a contract, and this trade for 100 ticks gets me out of the hole, right? 50 ticks a contract gets me out of the hole. The point of these videos, and I will be clear on days where that is the case, where it's not one and done. I'm very clear about that. But what I am trying to show you is that you can hold on to targets, and I'm trying to get you to understand that that's the key to success. And so I put a video out here. If you go to our website, the homepage right now will have this particular trade on it, or if you go to the blog section, there are just more videos than you can count showing you this type of information. All right, so let's take a look at the chart here. This red line that you see, or this brown line here, is one of our favorite retracement setups. We entered into it at this position, and we had these different targets that we were searching for down below, right? These different targets are different levels. We use the speed of the tape. We use other tools to let us know why you would reach out to this market structure extension 1 where the market ultimately paused, right? We teach you how to do that, but that understanding that this was the entry and that the target could be down here, which we took, could be your potential opportunity, your reward. Now, we use another tool, an order flow tool, and here's a screenshot of that very trade. We were looking to get short here at 49.11. We had an 11-tick stop. This should be, or sorry, it should be a 10-tick stop up to 21, right? 49.21. And if you'll notice the liquidity that was on the book at the time, there was a ton of liquidity above you here. It gave us good confidence that our entry at our favorite retracement point was going to work. And then if you'll notice down below, there were no buyers underneath you here. So as the market rallied into our entry, we had a nice tight 10-tick stop, and we had all of this reduced liquidity underneath us here that allowed us to have the confidence to hold on to the trade. That was September 8th. On September 15th, we had another trade like that, where it went 132 ticks. Again, you can go to the website. This trade was posted. You can see the entries and exits on the price ladder in this video here from the 5th. I'll go through the review with you, and you can take a look at that on the website. But again, another idea here. We had a market structure extension market maker level. We had the parameters and the ideas to take us to this level up here. And this entry here to this target allowed us to hold on with a small stop here at this 12-tick stop below this recent swing. Now, a more graphical display here. This is where the stop was below this area of liquidity on the book, right? If you're reading your order flow, there was a area of liquidity on the book here, and that allowed us to put our stop down below, and we just rode this out until it climbed all the way up to our target. All right, so similar ideas here. We had an ES trade where we got long off of our structure signal to the target. This particular trade on the ES is also on the website, and just more sort of examples here. We had this short here with a stop above 53.21. The short was right at this liquidity point. You had a stop above the liquidity here, and we held on for this target down to 52.78, and that is those are chart examples. Now, what I would encourage you to do is go to the website and watch the videos. They will give you a lot of additional information. The point of all of that is this: I'm not here to sell you on levels or any of that kind of stuff. I'm here just to say to you this: you've got to figure out, you don't have to do anything. Let me say this differently. It will be in your best interest if you could figure out how to get to certain points on your chart to where you are getting to 2-to-1, 3-to-1, 4-to-1 risk-reward ratios, and our approach with our levels allow you to be able to understand how to do that, right? You can, if you have your own way of doing it, then that's awesome, right? But we should all be aligned with the same idea, which is to cut your losers short and let your winners run. Okay, my favorite tool, the OTG Risk Analyzer. You can see Dr. Freud there sitting in the chair. I will call this is our desktop psychologist. I'm going to show you this here in just a second. Let's talk about it really quickly. It's an Excel spreadsheet designed to analyze your risk given your current trading parameters. And so in just a moment, we're going to go back and plug in those parameters that I showed you here for the last 90 days for us. Also, you can model what-if scenarios to determine best-case scenarios for your varied trading conditions. And again, I call it the desktop psychologist because during periods of drawdown, and there always are, I use this tool as a reminder that the system, it reminds me that the system is okay and that all I need to do is stay the course. All right, so let's talk about this spreadsheet here for just a minute. All right, let me bring this down here in front of you. Okay, and we're going to pull this over here. All right, so hopefully you can see that okay. Maybe I'll increase the view just a little bit here. Whoops, not that much maybe. How about like that? Okay, so I'm going to quickly go through what the spreadsheet is and then how you can use it. We're going to do a couple of what-if scenarios, and then I'm going to show you how this risk management tool will help you understand your trading system. So assume you want to put in your initial equity here. So if that's a $20,000 account, that's what you'd put there. If it's a $100,000 account, that's what you would put there. We're going to go with $50,000 here. The risk per trial, okay, is 0.44%. So if you'll recall, I had an initial, over that last, you'll recall from the statistics that I showed you, my trading, we were averaging about 9.8 ticks per contract, so about $196 per trade. If you take $50,000 and you multiply it times 0.4, that's actually an 11 tick stop, okay? So this is 11 ticks per trade, or $220 per trade. We're going to factor in $10 for commissions and slippage and all of those things on every single trade. Now, that doesn't happen on every single trade, so that's a fairly good representation of what you can expect to happen with a $10 slippage and commission ratio. Now, let's go back here and take a look. So let's assume for a minute that you are a trader who is winning 55% of your trades. All right, we're going to plug in some numbers here, and what this spreadsheet's ultimately going to do for you is it's going to take these parameters and it's going to randomly distribute it out over the course of 100 trades, hypothetical trades. This is what your win rate, your win percentage, your risk, your reward is going to do over the course of the long term over 100 trades. That's what this spreadsheet's going to do for you, okay? It'll make more sense when I start to plug it in. Let's say you're a 1-to-1 risk-reward trader, okay? And let's say you're winning 55% of your trades. Also, let's say that you are a 1-to-1 loser. So when you lose, you're going to lose the same amount roughly that you're going to win. And let's assume for a minute that you're at 45% losses And just for the sake of easy here, we're going to make your break-even trades at 0. Okay? So I'm going to hit start, and I'm going to run all trials. All right? So what this is going to do is it's going to randomly distribute out 100 trades at those parameters. So with a win rate of 55%, hopefully you can see this, with a win rate of 55%, your profit here would be $1,060. Okay? So with a win rate of 55%, you'd win $1,060 on 2 contracts. Okay? Now, let's go back here and let's run it again and let's see what happens. So again, remember, if you're averaging over the course of X number of months a certain win percentage, it's not going to be the same every single month. Some months it's going to be 40, some months it's going to be 60 to get you to the 55 number. So we're going to hit start and run all trials. And this time you lost $265 this month after commissions because your win rate was 52%. So you won 52% of your trades, and yet you lost $265. Now that's frustrating, right? To say, gosh, I won 52% of my trades, but I still lost money, and that happens. So we're going to run it one more time, and then we're going to go to my numbers. Okay? So we're going to hit run all trades here, and this time you made $1,500 when you won with your risk reward at or your win rate here at 56%. Okay, 56%. You had 1,560. At 52%, you lost money, and at 55%, you won just a little over $1,000. Now, let's go here really quickly, and we're going to use the numbers that I showed you earlier, right? So I'm going to plug these in. See if I can do this without. Okay, we're going to hit reset, and we are winning a 2.3 to 1 risk reward. I am winning 34% of my trades. Okay, when I lose, I'm losing 1 to 1. I'm actually losing a little bit less than what I'm going to put into the spreadsheet, but that's okay. I'm losing 49% of my trades, and I am break even on 16% of my trades. Okay, so we'll actually 17% here. Okay, so that's 100 trades. Yes.
Just real quickly, it looks like your screen has shifted a little bit there to the left.
Yeah. So what I've done is I've just got the spreadsheet here so that you can see these numbers that I'm plugging in here. So I'll move this back.
For interrupting. Yep. No worries. Sorry about that.
Yeah, no worries. It's good. Thanks for looking out for me. So with a 34% win rate at a 2.5 to 1 risk reward, right? I'm losing or breaking even on 66% of my trades. We're going to click reset. We're going to click start, and we're going to run 100 trials through this, okay? At a 34% win rate. Wow, look at that. During that window, doing it that way at a win rate of 43%, which is higher than what we plugged in, that's an almost $12,000 profit in that same window, right? Lost a lot more than I won, but still profitable, $11,000. Hit reset. We'll run it again. We'll run all trials. And now you're at 10,000, almost 11,000 at a 41% win rate. So remember what this is doing, okay? This is saying that, hey, your average is 34%, but it's going to be a little bit higher in some months than it is in other months, and this is accounting for that kind of statistical probability. I'm going to run it one more time, see if we can get a lower month here. Okay, here's a great one. Here's a great example. You won $3,000, okay, on a 29% win rate. Think about that for a second. 29%. Remember, I never got to $3,000 at a 1-to-1 risk reward. When I was winning 56%, I was only half as profitable as you are here at 29%. That's crazy, right? That's crazy. Now, let me show you this. We're going to run it one more time, and I'm going to show you one more thing. I'm going to show you why this tool can literally save you thousands and thousands and thousands of dollars in trade room systems and programs. Okay? Here's a $9,000 win with 38% win rate. This is a $9,000 win. Here's why this trade tool can literally save you thousands of dollars in trade room and education expense. Okay? So let's say that you came into my trade room. on day one at trade 35. You like the way I sound, the charts look cool, everything looks good, you feel pretty good about me, but you see this happen, right? I take about 4 trades a day. You see 1, 2, 3, from trade 35 down to trade 65. That's 31 trades. I win 1, 2, 3, 4, 5, 6, 7, 8 out of that 31 trades. 8 divided by 31, that's a 25% win rate. I've lost 75% of my trades, and you're going, holy cow, this guy's terrible. Now, keep in mind, even with that run right there, I was still up $9,800 on 2 lots of risk, right? That is the power of this. That's why when you buy that trading system, and you're buying it because you saw me win 4 days in a row, okay? You saw this run right here, okay? You saw me go through it. You go, man, I got to get some of this. That's really cool. There's, 2, 4, 6. There's 8 trades. He won 6 of them, and look at that, man. It's great. That's a win rate of 75%. This guy's awesome. Look at it. I won that much every time, blah, blah, blah. And then you buy it, and you come to this little string right here, okay? Right, you go through that little period right there, and you say, holy crap, I got stuck again. I bought another crappy system that didn't work. I knew I should have given it more time than 2 days and 8 trades. I knew I should have done that. This system sucks, and you pick up and you move on. But in reality, this gets all corrected later in the string. This starts getting corrected down in this area here because you're winning double what you're losing. And those are real live numbers that I've plugged in for what is actually happening to me this month. 2.3 risk reward, 1-to-1 when I lose, right? That is the real life scenario that goes on in trading. So my question back to you earlier, isn't it better to win less as a percentage of wins and win more when you do win? That's obviously a better approach to trading, because you're not getting paid on win percentage. You're getting paid on how much you put, how many ticks you put in your pocket at the end of the week, month, or cycle, right? That's what you're doing. So buy my system or don't buy my system, visit us, don't visit us. That's not really why we're here today. What I'm here to show you today is that if you can make that simple switch, that simple approach switch, from 1-to-1, take one off at 10 ticks and let the other one run. If you can make that simple change, and it's going to be hard to do, then you're going to find that your results are way better with a lower win percentage than they ever have been at your super high win percentages, right? If you are not properly managing your risk reward ratio. So let's recap here. I've been here with you about 58 minutes. I had a little bit of a get up. Let me just get through here with you, and I'm going to recap. The key to being consistently profitable trader is about managing your risk. There are 2 paths. You can have a high win rate. You can have high risk reward ratio. I prefer low win rate, high risk reward ratio. That's what I prefer. The way that OTG, the Oil Trading Group, achieves this objective is fairly simple. We cut the losers short, and we let the winners run. That's our strategy on the way that we achieve it. And your tactics need to align with your strategy, which also aligns with your ultimate goal of being consistently profitable. Okay? That's the steps. So I did promise you that I was going to make you a special offer here, and then I'll get to your questions. We have a special offer here today for you. If you go to oiltradinggroup.com/OTO3 for $47, I'm going to give you that setup that I told you earlier that made $1,700. I'm going to give you that setup. It's going to be included in this. That risk analyzer spreadsheet that I just showed you that you think, man, that's kind of a neat tool. The one that can literally save you thousands and thousands and thousands of dollars in trade room systems and purchases. I'm going to give that to you for 47 bucks. I'm going to give you 5 days in the live day trading chat room. I'm also going to give you 5 days worth of CL and ES trade plans so you can come in and take a look at what we do and how we do it. oiltradinggroup.com/OTO3. That's your special offer. Scroll to the bottom of the page. 47 bucks. You're going to get all that stuff there, the spreadsheet that I just showed you, that trade setup that we picked up that was $1,700 trade, the entry for that for 47 bucks, all of that stuff there for 47 bucks, 5 days in the trade room, etc. Okay, that is my sales pitch to you here. Let me go through here and look at answering your questions. So there's a question here that says, what is the time frame that I use? I look at all time frames, but my entries and exits come in on a 3-minute chart on the CL and a 5-minute on the ES. Does your tool also work with stocks like the trial, for example, or like Tesla? So, you know, the levels are not going to work on stocks, but that spreadsheet and this setup that I'm going to give you here for 47 bucks, it does work for stocks. It'll work for any market. That setup for 47 bucks is super cool, and it'll work on anything that's got a chart. So it'll work on anything. Do two also work? Okay. What is the web page? It's oiltradinggroup.com, Luis.
And Jason, I put the link to the offer in the chat box for everyone, so that's there as well.
Oh, cool. Very cool. Very cool. What if your account size is 10K and you are a one-lot trader? Should I not trade? No, you can still trade. You just have to keep your risk in line, right? And again, I'm not your financial advisor, of course, but you know, one lot, 2% risk is 200 bucks. So you could take 2 trades on the CL at 10 ticks loss each, right? And then you're done. That's what I would do, right? If you do 1%, it's 1 trade, 10 ticks. You get in, you come in, you go for the next day, and you learn how to manage through your one-lot trade. Now, there are what I didn't even talk about here for you today. In fact, I deleted the slide. We have put nearly 3 dozen people through prop trading firm Top Step Traders combines. We've put nearly 3 dozen people through that. And that's a place where you could get funded from $30,000 all the way up to $150,000. And they love the risk management stuff, right? They're professional traders giving you money to trade for them. And so it's a place that you should consider looking into. And like I said, we put nearly 3 dozen successful people through that where they've gotten funded accounts from Top Step Traders. So if you have a $10,000 account and you say, well, you know what I'd rather do? I'd rather go over here and test my skills and see if I can get a funded account with Top Step Trader. Then, you know, we'd be the place for you to help educate you, because we put, like I said, nearly 3 dozen people through that process over the course of the last year or so.
Hey, Jason, we've got one more question here, and I think we're going to have to put it on the home stretch here. But do you have to use or buy a particular or a certain platform?
So the indicators are on Ninja, but the measurement for $47 that I'm going to show you in that Excel spreadsheet. So if you have a copy of Excel, you don't need Ninja Trader, obviously. And if you can learn how to draw a simple pattern on any trading system or any trading platform, this $47 indicator will get you what you need.
Cool. So we have another question here. If someone wants to know if they can start the 5 days next week.
Yeah, absolutely.
Cool. Folks, I know we're coming just a minute or two over the hour mark here. We appreciate the time that you spent with us. We'll send a follow-up email with the links, as well as a link to the recording, a link to Jason's site. There's also going to be an ebook that's coming out, so please keep an eye out for that as well. Jason, this was awesome. Thank you very much.
No, I appreciate the time here today, and I'm sorry with the brief distraction there and that I ran a little bit long, but hopefully you can tell I'm fairly passionate about this stuff.
Of course, of course. For those of you, just a quick reminder, this is being recorded, so we'll be sure to get that out to you. And I don't see any other questions coming through here just yet, but they usually come through afterwards via follow-up email, so please don't hesitate to reach out. You can always reach us at info@topshelftraders.com. And Jason, is there an email address that we can put in here for the audience for you if they have follow-up questions?
Absolutely. Jason@mailotg.com. Jason@mailotg.com.
Perfect. I just put it in the chat box for everyone here.
Cool.
So, Jason, thank you again. Everyone, have a fantastic weekend. Thank you very much for joining us, and keep an eye out for the next event. We'll have a couple of them next week, but let's have a good weekend and a good start to our week next week.
Thanks, guys. I appreciate your time.
Thank you.
All right. Take care.
Thanks. Bye.